Well, good morning, and thank you for joining us here for the first of the panels for today. My name is Michael MacKenzie, and I'm the US Markets Editor for the Financial Times in New York. And I've obviously spent quite a few years now writing about high-frequency trading, algorithms, and all the sort of funs and games that's all been going on, particularly this year. So I think it's a great opportunity here to have these gentlemen from three of the big exchanges, and of course Andy here from one of the big buy-side investors, to get their thoughts and views. And to kick things off, I'd like to ask each member of the panel here to give a brief description of what they do, who they represent, and what their major concerns are regarding current market structure. So, Andy, if you'd like to kick it off.
Sure. Good morning. Thank you, Michael, and thanks, Rena, for inviting us to speak this morning. On behalf of T. Rowe Price, I'm delighted to join you all today to discuss issues surrounding market quality. T. Rowe Price is celebrating our 75th anniversary as a firm advising clients. We're a Baltimore-based global investment management firm. As an advisor, we advise clients with over $540 billion in assets under management. As of June 30th, 2012, we advise over 3 million shareholder accounts and serve individual as well as institutional investors. And I think as just a sort of a point of departure for us, I think our main concern, and Maureen really hit on so many of the key issues. I'd love for you to come sit on our trading desk sometime and really spend 6 months and help us figure out market quality, because we're struggling. We worry about investor confidence. We worry about the erosion of investor confidence, and we worry that the markets have lost their sense of fairness and balance. And the commitment to that fairness and balance, which has really been a hallmark of our equity markets for so long. I started at the firm in 1980, and so I'm in my 33rd year. So I've seen a few things and a number of episodes which really have undermined investor confidence over the years, and we rebuild it, which is always terrific. But now I think we're particularly challenged, and that was really well timed to have that article on the front page of the Journal today talking about order types. We're concerned about new order types. How many ways do you need to express that you want to buy and sell a security today? That seems challenging to us, and I think we're fairly certain nobody truly appreciates what's behind the drive for these new order types and why they're being approved and why they're necessary. We are concerned about equal access to market data, co-location, latency. These are very complicated issues, very complex problems, but is there fairness? Should anyone be able to see the end of the horse race before someone else? Should somebody get tomorrow's Journal today? You know, that doesn't seem right to us as we think about things. And by the way, the market requires all kinds of participants in order to operate efficiently. And what we're looking for is the balance between long-term investors' needs and goals and short-term investors' needs and goals. T. Rowe Price does not make an investment decision hoping to profit this afternoon. We're looking out 18 months. So we want to win, but we want to win over time. And we want to win in an environment where there's fairness and access. And I think at the end of the day, that's really what concerns us. I also think we are disturbed about the speed of the markets and this myopic push for faster and faster. And that, we think, could be destabilizing. And I think at the end of the day, this is a good time to hit the pause button. Let's reassess. Let's take a look. Let's bring everybody together and really go after this and try and figure out what can we tweak, what pilot programs can we launch to really look at market quality. Eliminate all fees, all maker-taker fees, other inducements for order flow. Wouldn't that be interesting? Okay, charge a fee for access, but don't charge a maker-taker fee. That would be kind of an interesting. Wider spreads, Maureen mentioned earlier, we're in favor of that, and not only for small companies. General Mills doesn't trade so well, in case you haven't noticed, sometimes. So a wider increment experiment would be good. There are a lot of different pilot programs. Charges, perhaps, or fees for high cancellation rates, other things, minimum quotes, minimum quote accessibility, all those things deserve examination. We think it's a really good time to pause and step back and gather and try and figure out some of these issues. Thank you.
Thanks, Andy. Good morning. My name is Chris Isaacson, and I'm the Chief Operating Officer of BATS Global Markets and a founding employee of BATS. Appreciate Georgetown putting together this conference. I think it's a very appropriate time to come together. Many of the topics that I'll echo some of Andy's comments. Financial markets, especially in the U.S., we're all aware, have changed dramatically in the last 15 years. Numerous changes in regulation, starting with the order handling rules, Reg ATS, Reg NMS, have transformed the market, along with the mass adoption of electronic trading. These have all resulted in much greater competition amongst market centers and many of the good things that Maureen talked about: tighter bid-offer spreads, lower execution costs, and faster execution speeds. Now, while these changes have empirically benefited investors, difficult prevailing macroeconomic conditions have caused a drag on investor returns and a reduction in the number of IPOs in the U.S. In addition, well-publicized episodic events that Maureen talked about, such as May 6th and the many well-publicized events of this year, have fueled concerns about the quality of our market and the overall investor confidence in it. In the wake of May 6th, I believe the industry has done much to enhance market structure, including single stock circuit breakers, elimination of stub market maker quotes, and there will be more completed early next year with limit up, limit down, and the new market-wide circuit breakers based on the S&P 500. The technology problems this year have raised additional concerns about the level of control about the technology that drives our capital markets. Work is being done to share best practices towards the prevention of technology problems and to ensure that when they occur, their impact is limited such that the broader market's not affected. In this regard, we're all aware the SEC has a roundtable coming up on October 2nd. While the market structure has changed dramatically, the measures of execution quality have not. Quoted and effective spread, execution cost and speed, accessible liquidity within a certain distance of the national best bid and offer, and price improvement remain valid measures of execution quality regardless of the fragmentation or speed of the market. All of these metrics show positive trends in the recent years. However, as an industry, we should not rest easy. There are topics under discussion today that may impact the perceived and or actual quality of executions in our markets in the future, including the amount of off-exchange trading, what appropriate tick sizes ought to be, and whether certain classes of participants should receive special treatment. I'm encouraged that these market quality issues are taking center stage in our industry, as I believe thorough analysis of each issue and appropriate action where necessary will make the markets better. I look forward to discussing many of these issues with my fellow panelists and moderator.
Good morning. I'm Eric Noll from NASDAQ. Thank you for having me here today, and I appreciate the opportunity to be on this panel with my esteemed colleagues here to talk about some of these issues. Echoing some of the things that Maureen said earlier, I think one of the issues that we're particularly troubled about at NASDAQ is the dearth of liquidity in small cap stocks. When I look at our market listings, it's just not an effect on NASDAQ, it's an effect across the market. Our bottom 1,000 listed names account for less than 1% of the traded volume on a daily basis. That's 1,000 names. That to us signals some real concerns about one of the primary purposes of capital markets, which is to raise capital for new companies, to provide a valuation of equity capital for companies that are already public. And as we look at that issue and we look at different ways to address that issue, we are struck by a notion that we live in a world where one size fits all for current market structure. And some of that is dictated by regulatory concerns under Reg NMS. Some of that is dictated by the competition among exchanges for additional flow. But I think the time might be now for us to think about differing market structure models for different kinds of companies and different kinds of liquidity needs and different types of capital formation. And so we've become increasingly concerned about that, particularly with the Jobs Act being passed by Congress and other movement in the marketplace to increase or otherwise enhance private capital raising. And there's much about that to be admired, but I also think that there's a lot for us in the public markets to be concerned about as well, which is we aren't answering that call. The reason why venture capitalists, the reason why private equity firms, the reason why new entrepreneurs are so eager to pursue private capital raising methodologies, or one reason, is because it's not effective for them or efficient for them to go public on our markets until they're much larger. And so I think that we in the public space really have to address that. We really have to look at how should our market structure evolve in ways that really allow us to make a difference for capital raising and capital formation for small cap stocks, not just small cap stocks, but new stocks. I also wanted to touch on real briefly some of the comments that Andy and Maureen had earlier, and I relate them to market quality. Market quality has been dominated by price in terms of the way we look at market quality, the way most people measure market quality, and obviously the price at which you can buy and sell a stock has to be paramount in terms of measuring market quality. But I think there also has to be some consideration given to other metrics, one of which has to be certainty of execution. How comfortable am I when I send my order that I'm going to get the price that I see, or a price reasonably related to the price that I see? And a second area, perhaps more important than the first, is liquidity. And what we have seen in our marketplace is a fracturing of liquidity into smaller and smaller increments. The issue that Maureen mentioned in her paper about Apple and Google trading in odd lots is a prime example of that. And I've thought a lot about that particular issue and on whether odd lots should go to the tape, not go to the tape. There are unintended consequences, of course, if they go to the tape, not the least of which is, do you allow quotes in odd lots? And if you allow quotes in odd lots, are they now subject to Reg NMS order handling rules? And does that dramatically increase the message traffic on the system? Does it impose an unfair tax on data distributors and data market data customers to be able to interpret and read all the new quote and message traffic on odd lots? So it's not as simple as just saying, well, we should just put odd lots on the tape. I think it's a much more complex issue than that, but one that I think that we have to spend some time talking about. And to echo some of Chris's comments, I think the next evolution of what we're going to see, at least from the exchange space, is what else can we do to provide risk management tools to the marketplace? What are the other things that we as an industry, as an individual exchange, as a collective of exchanges, can we do to provide additional stability and risk management tools to handle the outlier events, the episodic events that occur? Quite frankly, I don't view that as a competitive matrix for NASDAQ. I view that as an industry problem. I think my colleagues agree with that. We've been working together and will continue to work together on this issue because we think it helps bring real stability to the marketplace.
Morning, I'm Joe McCain from NYSE Euronext. When we were getting settled into our seats, I realized I had the unique opportunity to make a few cheesy Clint Eastwood jokes, just given the setup of the dais, but I'll refrain, but thought it was worth highlighting. Anyway, I'll, at the risk of not repeating a number of the things that were said by my fellow panelists, I'll try and generalize and maybe comment specifically about the complexity of our overall market structure, which I think generates a lot of the debates that we're having and a lot of the issues that get raised. A lot of the things that get cited as problematic in our market structure are complex issues. A lot of the reason why a lot of the items that get highlighted evolved and why nothing's been done is because there's usually a very valid market structure reason or business reason why things have evolved the way they have. When people comment on the number of venues that are out there, a lot of the reason why the number of venues that are out there have proliferated is because of the structure of Reg NMS. A lot of why speed has become such an important issue to a lot of people in today's trading environment is because there is top-of-book protection for a lot of venues. Maker-taker, in a lot of ways, has evolved because there's an incentive provided to liquidity providers, some of which is to compensate them for the fact that not all orders make their way to the public markets. There's a certain level of complexity or a toxicity that exists in the public markets, and so there's a transfer payment, in essence, for people to be willing to provide liquidity in the markets. A lot of the order types or routing orders that get highlighted are because people have very cost-sensitive or have very economically sensitive models that they're using, and cost becomes very important to them. And I think the general point is that each of these items interrelate, and they can't be addressed as one-offs or in isolation. And in my opinion, that's a lot of why in January of 2010, the SEC kicked off their concept release review, because there was this level of complexity and interrelatedness that, doesn't really lend itself to, solving this particular issue or changing this particular piece of market structure, because it does have unintended consequences or because it doesn't address the whole problem. A lot of that got sidetracked for obvious reasons, given the flash crash and a lot of other things that have happened in the meantime. To me, it's maybe the right time, as a lot of these issues continue to come up, to revisit the broader market structure and, to have more of a framework debate rather than, getting into kind of the nitty-gritty of colo good, colo bad. A lot of these things just are, and to me, should be debated more in the context of what we want the overall market structure to look like. Along those lines, the second thing I would highlight is, in my opinion, there's way too much focus on individual actors in the market and whether they're good or whether they're bad or whether they're acting constructively or deviously. A lot of what happens in the market and a lot of, what Maureen O'Hara highlighted, again, stems from the type of market structure that we have and people trying to either provide value, create profitable business models, service their customers within the context of the market structure that we have. A good illustration of why, again, the issues are more complex than they appear, without going into a lot of detail, but just to maybe highlight one of the slides that Professor O'Hara put up, and I won't specify which one, but I do have a little inside information on, because we had looked at it, and one of the seemingly algo or predatory behaviors that was highlighted was actually done by an institutional agency algorithm. So a lot of people look at the types of things that get highlighted and automatically assume, oh, that's one of these big bad high frequency guys. And look, I don't have an agenda with that. I'm not here to defend or villainize anyone, but the point is, it's not as simple as saying, these are proprietary algorithms that are, acting in a predatory manner in all cases. Certainly some of that behavior exists. Certainly any attempts to manipulate the market should be enforced and people should be disciplined, but a lot of what gets seen or observed or criticized, and rightly so, doesn't always emanate from the party that you would think generated it. And so, again, that's just more of a general point. I think, again, it just highlights the complexity of the world that we live in and why maybe a more holistic review of market structure is warranted.
Thanks, Jeff. Well, on that point, it's probably worth looking deeper into the role of regulation here, because it strikes me that since Reg NMS came about, we've seen this market develop, fragment. We've had all these technology issues arise. At what point does the industry need a regulator to take a much tougher stand and actually overhaul the entire market structure? And if so, is it achievable? And what kind of structure are we looking at? Mindful, of course, that this would require the regulator to balance the inherent business decisions and motivations of all the various actors in these markets. But someone, strikes me, needs to sort of make a stand here and actually sort this market out, particularly when you've got the sort of algorithm problems we see, the different types of algos, the different types of high frequency trading, and the vested interests of the various actors in this industry. I don't know if you want to take it, Joe, or someone else.
Sure. I think there's two interrelated points in that question. One is around ferreting out what I'll call bad behavior. The other is around stepping back and looking at the broader market structure and whether there should be changes to how things fundamentally operate. I think on the first point, clearly, I think the SEC and FINRA have been trying to move in that direction. A lot of what gets highlighted is whether the pace of regulation has kept up with the evolution of market structure. Things are very complex. There are a lot of very sophisticated algorithms, programmers, computers that are generating a lot of the activity market-wide that we see. And, clearly budgets are what they are. I think the main question that gets highlighted is whether the amount of resources, development time that is available to the regulators to catch these types of behaviors is adequate. I don't know the answer to the question, but I think that's one part of the debate. And then the second part more fits into the re-examination of the broader market structure, as I was alluding to before. As I said, I personally think that the same issues seem to come up pretty regularly by a pretty wide variety of market participants. As I said, I don't think they get necessarily addressed largely because you can't address them in isolation. And so, I would argue that the way to maybe address these types of debates is through, whether it's an NMS style series of market structure roundtables, just to, discuss a lot of these items as an industry, and to have maybe a holistic recommendation or series of legislative changes coming out of these issues is probably the right way to do it. And if, look, the conclusion of that series of debates is that people will like certain parts and people will dislike certain parts, but we don't think we should make fundamental changes, then, we would need to accept that as a possible outcome. But it seems like there's enough debate and interest around the same recurring topics that it might be worthwhile.
Andy, you talked about regulating speed. Do you think that's a step?
Well, I think you're right, Michael. It's probably a good time with all of this discussion to think about regulation. And all the changes we've seen over the last 15 years were with good intention. And, the markets, I think we ought to stress, they open on time, generally. They close on time. Trades settle. Things are working for the most part. But it's below the surface that causes some anxiety. So if the high-frequency trading strategy crowd is taking out $5 or $10 billion every year out of the system, who's that coming from? Somebody, investors. And, is what they're putting in worth them earning that much? I don't know, but I think that's worth discussing. And I do think that with the unintended consequences from regulation, we've probably gotten to a place that nobody would have said, this is where we should be. So it is a good time to step back and think about that. And I think, pilot programs and experimenting and really going after things and trying to iterate this would be a very constructive way to do it. It's awfully hard to predict what a change will actually mean when it comes into the market. And I think we've all seen so many examples of that. So we've got to practice. We've got to sort of experiment with the ability to look back and say, that didn't work. Let's try something different. It bothers me that we can't admit we've made a mistake or perhaps we've gone too far. We've innovated too much. We are too fast. We're too competitive. To the SEC's credit, I think they actually said, maybe we've gone a little too far here. And so maybe we can regather and reassess. And there's a lot going on here that causes anxiety. And I think Maureen put this pretty well, but at the end of the day, it doesn't feel good. I can't prove it to you. I'd ask for pilot programs and for data. Let the academics go crazy analyzing some of these things. But I can't bring you data that says, this is why I don't feel good. I just don't feel good. And the people I see on the street, at the grocery store, in the backyard, at school functions, they don't feel good either. They think the market has a persona of a casino. And boy, that's bad for our business. And everybody else's business here at the table, I would say. So.
That seems to be one of the main byproducts of what we've seen in the last, particularly this year and also since the flash crash. We've seen retail investors leave the market, flows going into bonds when bond yields are at record lows, which potentially doesn't make a lot of sense. But I suppose that's a longer-term issue for those type of investors. But is this a reflection that the stock market is considered to be a Frankenstein market controlled by these machines, and that the retail guy just doesn't have a shot anymore? I remember just recalling some of the headlines that came up after the Facebook IPO. It strikes me that it's going to be very difficult to drum up support amongst retail investors for another high-profile IPO, given what we saw. That strikes me as a very big challenge here for exchanges and for the industry in general.
Well, I don't think there's any question that, the headline risk over the last year has a negative effect on particularly retail investors. But I do think it's probably important to put it into context as well. We have lived through a very difficult economic time, and I think it's fair to say that that has real impact on people's day-to-day feelings about investing, where to put their money. Since 2009, but if you go back longer than that, people feel like they just haven't received the return that they were looking for in the stock market. Or what's been told to them over years, invest in stock, to echo Bill Gross's view, the equity growth story is gone. That has a real impact. It affects their wallets. And so that affects where they're going to put their money. And I think it's often easy for us to overlook that as a headwind for investor confidence. We tend to look at ourselves and say, okay, well, we messed up. We had these tech issues, we had these flaws, we had these other issues that drove investors from the marketplace. The truth is, investors have been leaving the marketplace from well before that for economic reasons. I think another interesting thing is we tend to view the health of our market based on the volumes we see. And unfortunately, as we look at that, we high watermark to 08 and 09, right? And when we look back at that, we say, oh, we were doing 12 billion shares a day. That was the greatest time ever. Because we're not doing 12 billion shares a day, investors hate equities or investors don't trust the marketplace. The reality is the 12 billion shares a day was the aberration. Where we are now is more of a normal. So if you go back and you map volumes across over time, you don't see today's volumes as the aberration. You see 08 and 09 as the aberration. And so you have to, I think, really look at those issues in context. I'm not trying to diminish the headline risk and the episodic issues that have happened in the past year. They're there, and they really do affect investor confidence. But I think there are so many other items out there that we have to really think about before we do radical surgery for things that may not need radical surgery.
I think it's also worth mentioning that there has been quite a bit of inflow into ETFs. Now, whether or not that's been retail-driven or not, it hasn't fully offset the mutual fund equity outflows, but certainly there has been a pretty strong trend of ETF growth over the last few years as there's been a flood out of mutual funds. So it's not fully offset, but there is some maybe silver lining there. I just echo what Joe McCain said. I think we need to handle BATS. We're for a holistic review of market structure. We were very excited about the concept release the SEC came out with in 2010 before the flash crash. And we think now is the right time to think about tick sizes, to think about dark pool off exchange trading, to think about the regulation of speed, to think about co-location. Like, let's put it all on the table, but think about it holistically and not piecemeal. And NASDAQ and NYSE and us, actually, we put a joint pilot program together around tick sizes in April of 2010. Now, our timing was impeccably poor right before May 6th. And so it got no airtime, but it still sits on the SEC website, asking for a pilot program and a few securities that are under $20 that are highly liquid. Now, we were asking for slightly smaller tick sizes, say half cents, but BATS, we're fully in favor of experimenting with illiquid securities or high-price securities where does it really make sense to trade in a penny? Maybe they should trade in nickels or dimes or quarters. I think this idea of spread leeway is very important. How many ticks should you have between the average quoted spread? I think the number is probably somewhere between 1 and 3 all the time. And when you look at Google, maybe you have 10 or 20. It's probably not trading very well. And I think it's of cause for concern, too, if you look at this week, in fact. there was a day, I believe it was Tuesday, I believe Monday or Tuesday, where the dark pools or all TRF volume off exchange was above 37%. We're at all-time highs, but the VIX is at 5-year lows as well, so those tend to be correlated. But you have 1,500 securities or so that are trading more than half off exchange. Clearly, I'm self-interested. I work for an exchange. But the fact of the matter is what's happening to price discovery. I think tick sizes and off-exchange trading are certainly interrelated. Now, around technology controls, certainly a lot of the technology advancements, I believe, would have come regardless of whether or not Reg NMS or the other regulatory changes occurred. But I think they did accelerate, or they gave incentive for the technology innovation that we've seen in the markets. However, the controls around technology, the SEC, all the exchanges are subject to the SEC ARP reviews. And there's certainly talk that those will not just become guidance, but will become actual rules. We're in favor of that. We take SEC ARP very seriously today, and there's actually talk of the extension of that review to broker-dealers as well. And I think in light of the issues we've seen in the last couple of months, that probably makes sense as well. I think the technology's maybe gotten ahead of the regulation or the controls a bit. I mean, it's hard to argue otherwise. So we're in favor of that, but I think that's not necessarily market structure. That's just adequate technology controls about how do you run an effective, critical market infrastructure, regardless of what the market structure looks like.
But, Chris, if you think about that, and you all are, you're well regarded on the technology front, aren't we generating too much data to be processed? I mean, there have been a number of discussions recently about the NBBO, and Maureen, I forget what you called it, the pretty good NBBO, thank you. I don't know how one finds out they've gotten best execution today with all these competing venues, 13 exchanges and 50-plus dark pools and stuff moving around. And I wonder if the concept of price improvement, which was a fundamental precept of the markets, that's out the window. I mean, when someone's improving by 1/100 of a cent and stepping in front of the queue saying they're bettering a customer's order that way, are you kidding? I mean, really? And if we start quoting in sub-pennies, we're going to zero on this. The marginal benefit, it seems to me, to investors is not there. And I really would love to see some good dialogue and discussion about how we can tackle those issues to make the market better so that investors feel like they're getting a pretty good deal.
So I think to answer your question about are we creating too much data, certainly there's been a lot of exchanges around the world and some here in the U.S. that have said we should do order-to-trade ratios to limit amount to mitigate the amount of quotes being disseminated. I don't think we're necessarily against that. I think we would all agree, however, that the bottom 5,000-6,000 securities in the U.S. just don't trade very well in this market structure. So applying a blanket order-to-trade ratio just doesn't work very well. If we're trying to fix the capital formation problem and bring IPOs to market, do I want to put a tax on a market maker for him making a quote in a security that doesn't trade very much? I think you have to have exceptions. In fact, in the futures market where you see a lot of these order-to-trade ratios, they exempt all new products because there's not enough trades to make that ratio look right. So it's a complex problem that I think is, maybe not counting if you're close enough to the NBBO. I think there is innovation to be had here around order-to-trade ratios. But I'm not convinced that's exactly the way it ought to work. Minimum quote times or minimum resting times, I think Maureen brought up some good points there. I think the impact of using that as a quote mitigation tactic will be wider spreads that will be paid by you, the institutional investor, or your investors, and the cost of execution. Now, you might get, as a result of that wider spread, the brokers may be able to tout higher price improvement on a wider spread, but your overall costs will be higher. So I think, we're all for looking at the market. I just think these are complex issues when you look at holistically.
I mean, is one of the problems here the fact that the regulators are so focused on making the markets transparent and really closing up that bid-offer spread, when the reality is you're not going to have liquidity, decent liquidity, unless people can actually buy and sell and be a market maker and have some protection? Do we need to sort of see these spreads go back out a bit?
Well, I think we think it would be a good experiment to analyze. Certainly, I think, Chris, your point about segmenting the market makes great sense. Different stocks require different, methodology to trade, and I think everybody'd be interested in seeing a wider spread to attract dealer or other displayed liquidity in stocks that trade, 3,000 shares a day. I think that makes a lot of sense. But we really, I think that the issues are incredibly complex, but here's an example. There was some discussion earlier about odd lots. Our understanding is the odd lot is now the mechanism by which a lot of market participants are, signaling, trying to identify signals, and trying to react to other signaling. And if that has lowered the barrier to entry to one share of Apple or GE versus a round lot of 100, does that sound good? Does that sound like that's improvement? Is that really what should be going on? And I'd be curious, do you all sense that the odd lot mechanism is being used by people that are looking for big orders out there to step in front of, or somehow opportune which way a stock's moving in the next 15 seconds?
I wouldn't say I have definitive evidence that people are using odd lots for that purpose, but I would say that BATS were supportive of odd lots being printed to the tape at the very least. Whether, Eric raised good points about how do they fall under the order handling rules? Do they need to be protected quotes? I don't know. I think we should take incremental steps here and get odd lots on the tape so that any games that could be being played right now by market participants, regardless of what segment of the industry they're in, that those trades should be on the tape. And Maureen had great evidence there, Apple and Google. There's the vast majority of those trades, unfortunately, don't make it to the tape, and they should. That's very important market information.
And to talk about, Apple specifically for a minute, right? So, where you see a tremendous amount of odd lot trading, for the most part, it's probably driven by stock price. Because if you're a retail investor, trading an odd lot of Apple is a very expensive proposition. It also happens to be one of the most famous stocks in the country, and people want to invest in it. And so many of the ways they can do it is the only affordable way for them to do it is to use an odd lot. And so how are you going to discern the difference between what is, an investing couple in Ames, Iowa, putting in an order to buy 10 shares of Apple from a guy who's trying to uncover trading interest?
Are you seeing the same kind of odd lot utilization in Dell or Intel, $10 and $20 stocks?
It's much, much higher in high-price stocks. Much, much higher.
But just to be clear, as I think someone mentioned before, the odd lot problem, or lack of odd lot reporting, is something that is getting addressed by the Consolidated Tape Association. All of the exchanges participate in that forum, and that's been on the agenda. It's also one of those things that might be worth highlighting. Is just a legacy item that was put in place when the Consolidated Tape was first created, largely to reduce the complexities and a lot of what was then manual reporting of trades, and to make it more manageable for the industry. And the thought was, it's not worth the cost, the benefit's not worth the cost of getting those reported to the tape. And then obviously the market evolves around rules that were created, 20, 30, 50 years ago. And then, you end up in a situation where a lot of very active stocks trade with very high prices, and then, someone like Maureen O'Hara will highlight the amount of activity that happens, and then the industry reacts to it. But, whether, to Andy's point, whether people are using it to try and manipulate prices, I think it's hard to say or to prove, but at the same time, it's hard to make an argument with the technology that exists today why we shouldn't just start reporting trades to the tape. So, I think everyone's working towards that goal.
I think it's also important, and Joe, you made this point earlier, but I think it's worth reiterating that there's a difference between what are flaws of market structure, ecosystem flaws, if I can call that, and what is bad behavior. Yeah. Bad behavior just takes on new forms. There's really, if I could use this phrase, nothing new under the sun, right? When the market was all manual, there was bad behavior because people behaved badly. Now people who are bad actors use technology to behave badly. that's a question of rule enforcement and prosecution. And so bad behavior, no matter what it is, should be caught and punished. And in today's sophisticated world, it's not a bad floor broker or a corrupt market maker, it's a bad algo or a bad computer system. So those have to be identified. Those people should be taken to task for their bad behavior. And I think it's important that you draw the distinction between those two, because we live in a world, regardless of whether we like it or not, that is technology driven today. And I think we just have to look at that in that lens and identify what is an ecosystem problem from what is a bad actor problem.
So on that point then, Eric, is it a job for regulators to do this, or is it a job for the exchanges?
Well,
or the broker-dealers?
quite frankly, I think it's all of our jobs. I mean, I think it's the regulator's job. I think it's the exchange's job to have appropriate rules. I think it's FINRA's job to be able to surveil, track, and punish people who violate those rules. I think it's industry participants' job to raise the flags when they see what looks like bad behavior, to regulators, to FINRA, to exchanges to say, hey, we're seeing, lousy behavior. Before I came to work at NASDAQ, I worked for an options market making firm. And one of the things that, we did regularly is when we thought somebody was using options for insider trading, we'd pick up the phone and we'd call the regulator and say, we think somebody just used this option to engage in insider trading, and left it to them to do it. So I really believe it's all of our problems to try to figure this out.
I completely agree with Eric, and that I think there's an enormous amount of effort going on right now. The SEC has approved the consolidated audit trail, and any gaps that we have as SROs, self-regulatory organizations, we believe will be filled in with the consolidated audit trail. And so we're spending an enormous amount of time, and we look forward to having all the data at our hands so that all of us exchanges, as well as the SEC, can root out any bad actors that may be using the fragmentation today to play games that they won't be able to.
On that point, I think that's really interesting, and we're certainly in favor even of all the regulators coming together and getting real-time data, to be only used by them in analysis. But the CFTC, the SEC, the Fed, it was somewhat startling that the May 6th flash crash analysis took so long and yet was perhaps still incomplete because it's so complicated and no one really had the data. So I think we've got to sort of know as an industry exactly what's going on, and anything we can do to make that happen and be done in a safe and secure way is something we're certainly in favor of.
But it's quite interesting here because we had a Chicago Fed paper yesterday came out talking about risk controls at exchanges and made the point that pre-trade risk checks vary. There doesn't seem to be any standard. They also make the point that they discovered more out-of-control algorithms were more common than they'd anticipated. We seem to keep coming back to this essential question here that the regulators who created this market, it's fragmented, you've got all these different people doing different things in their own self-interest, and you get the distinct sense here that no one's really in charge, no one's really making a decision, no one's really trying to enforce bad behavior, and no one's really unsure of when the next night-type software problem could erupt and what the consequences could be for the market, which then, of course, leads us to sort of the question, is there a systemic danger out here that at some point we could see a much bigger repeat of what happened tonight, unfortunately, this year?
I guess there's a few points in there. One is, as one thing that was definitely missing from the industry was market-wide mechanisms to at least stop trading or slow down trading, obviously very, very much highlighted through the flash crash and the development of circuit breakers, limit up, down. I think the lesson learned there was, all electronic all the time is not necessarily the way for the entire market structure to operate. And unfortunately, sometimes it does take a May 6th type event to get everyone's heads wrapped around those types of situations. If May 6th didn't happen, there would, in my opinion, never have been market-wide consensus about building some sort of circuit breaker or something along those lines. So as fortunate as it is, sometimes you need to have situations like that to move structure forward. You know, at the same time, the other side to that, and what I think we all need to be careful about, is every time something happens in the market, the immediate reaction is we should put rules in place to prevent that, right? We should stop that from ever being able to happen. And the obvious danger with that is, you know, the further you go down that path, you start to interfere with the normal operations of the market, which we obviously want to avoid. And related to that, it's important to also note when there are rules in place that, for whatever reason, didn't work, and separating out where do we need new rules, where are the rules in place that maybe didn't work as designed and need to get tweaked, and where are the rules in place that maybe weren't followed. And I think any market event, either past or future, will generally fall into those categories, and we need to be diligent about classifying and reacting to them the right way, and, you know, not always reacting to whatever happened as we need a new rule to cover that. As Eric said, you know, it doesn't mean that we shouldn't look at additional market-wide protections, maybe secondary backups, but, you know, at the same time, you know, there are rules that generally should prevent some of the problematic behaviors that we see, and then it's just a question of, are they well enforced, are they well regulated, are they being followed?
You all, as three exchanges, of all whom I respect immensely, do you feel that part of the challenge today is
It all matters before the but, yeah.
Well, I mean, but you have a central role in our markets, and we're in there every day for our investors, and you all do wonderful things most all the time. But is maybe part of the reason we're in a little bit of a jam is the compensation scheme? And so as you all are for profit today, and you're interested in volume growth, how do we find that balance? And I don't know how the regulators or others help us with that. And that's not the only issue, of course, because it's just part of so much of the complexity here. But if you're all about volume growth, I don't know if that's so good.
Yeah.
And maybe the charges to the retail investor aren't really representative of the costs. And do we really need to look at some of the money sort of that's changing hands here and really properly assign costs to users?
Yeah, look, it's a great question. I don't know that there's a good answer to it. Clearly, it's a balancing act. We all wear two hats, right? We have a duty to the public markets, and then at the same time, we also have a profit motive. So, you know, it's a matter of, like any business, you know, T. Rowe has a fiduciary duty, and you know, it's a balance that we all have to try and find in our operations. You know, I do agree that it relates in a way back to the proliferation of markets and, you know, the very, very high level of competition that exists among the market centers. And, you know, at a certain point taken to an extreme, you know, do profits or margins get squeezed to a point where the requirements of an SRO and some of the things that we're talking about become difficult to fund? I don't think we're at that point, but it's certainly something that I think we're all cognizant of, and as an industry need to make sure gets highlighted. I do think to a certain extent that indirectly will become part of the consolidated audit trail debate, right? Because, you know, we're still pretty early on in terms of formulating that plan and trying to figure out what it's going to cost, and all the SROs and FINRA are working together to respond to the SEC's you know, request for us to develop such a plan. But the cost question of it is going to come up. It's too early to know what it is at this point, but, you know, the issue of who's going to pay for it, how it's going to get divvied up among the industry, I think is going to be a big issue.
I mean, you raise an interesting point, Joe, because, I mean, is it a case that we just have too many venues? Do we need to see some consolidation?
Personally, I think NASDAQ should be the venue, but It does raise an interesting question. I'm always a little troubled by that question, though, in the sense that, Reg NMS guarantees price protection, top-of-book protection across multiple venues, but we exist in a world, and we existed in a world before there were multiple venues, where there were literally thousands of small broker-dealers and off-exchange trading. And even in today's environment, the proliferation of alternative venues to listed venues is enormous. And I think I'm less worried about the complexity of that than I am just the sort of standard operating procedures and how we all work together. Because I think it would be hard to say that there's, sort of put your hand up and say, 13's too many. 20 is too many, 5 is too many. I don't think there's a magic number there. I think it's more about the health of the ecosystem as opposed to the absolute number of venues.
I mean, to me, the number of venues question is more addressing the effect than the cause. I think, back to my earlier diatribe, the question that I think should get asked is, why are there so many venues? And, is it because of the structure we have, and are there incentives that push people towards the creation of additional venues? Are the costs of operating in the venues shared properly such that, it doesn't incentivize the creation of additional venues where there perhaps shouldn't be? And I think that's more of the way to address the question, in my opinion.
Well, certainly the barriers to entry to creating a new venue are too low.
Yeah,
Wouldn't
I would
we
agree with
agree?
that.
I mean, I'd be good with 3 venues. You guys look fun.
I wonder what he says when we're not on the panel.
I think the markets, in some ways, is figuring this out as well. I mean, there's 13 exchanges, but not all of them have the same market share. And I have to pick on my competitors here a little bit. Their third exchange license may not have picked up as much market share as they'd hoped. And I don't know for what reason, but maybe the market just has a little bit of fragmentation fatigue. Markets tend to work, we believe, when we let them work with the right guidelines. So I don't think we're against new venues. Certainly, there's been more proliferation of off-exchange venues than there has been of exchanges. But I guess we as starting out as an ECN, as an off-exchange venue, turning into an exchange, we don't have any self-interest in closing the door behind us for other people to become an exchange. But they're going to have to go out and win the business just like we did.
So we have the SEC holding a roundtable early next month now. What would you like to see come out of this? I mean, I suppose we're being very optimistic to think anything concrete will come from this, but at the same time, in an ideal world, what do you think would improve the overall market structure?
It's tough to answer because I think it's hard to know, frankly, what direction that discussion's taking. It seems that conversation is going to specifically focus very much on technology and controls around rollouts and so forth. So assuming that's the general direction, I would think the outcome from that could be some sort of best practices or, guidelines around technology or potential controls and tactical type, technology suggestions. I don't think, and I might be wrong, but I don't believe the purpose or the agenda for that meeting is necessarily meant to address some of the broader issues that we're talking about. I think that's to be had at a later, broader time. So I think the tactical reaction to the October 2nd roundtable will be a very technology-focused one.
I mean, is there a danger here that's just sticking a Band-Aid or putting a sticking plaster on the problem?
I think maybe to echo a point I made earlier, if the reaction, I think the point of having that roundtable is to maybe diffuse some of the knee-jerk reactions of saying we need to put more rules in place, we need to just do things for the sake of optics or the sake of doing it. And my belief is, part of why the SEC assembles those roundtables is to present, some of the complexities and broader views around those types of situations. So in my opinion, you know, if it's a healthy and constructive dialogue, it should hopefully avoid that problem.
Right, okay.
You know, I think that you could make the argument, Michael, that part of the reason we're in the pickle we're in is because of the Band-Aid approach over the years. I think it would be great if the roundtable resulted from a consensus that we need to pause, a consensus that we need some sort of kill switch to be able to cut off access to the market from a algo run wild or something. That seems logical. How it's implemented, I would defer to the technology experts. And I think it wouldn't be such a bad idea to put a moratorium on approving new order types, because it seems like that we're going down a bad road on that.
Yeah, what are your thoughts here, Chris, on order types and the sort of kill switch?
So kill switch, I
Liability.
think there are complexities there that need to be considered, but you know, as Joe mentioned, there are, we believe, rules in place, the market access rules that may or may not have been followed in this case. I don't know for sure, because I wasn't a party to it, but I think we need to, you know, figure out what rules are in place, were they followed, and then is there anything across the exchanges that we can do. I think, you know, in the future space, albeit it's different, there are differences, but you have, you know, one exchange trading that entire product, and you have position limits, and that firm is shut off when they hit their position limit. We have the DTCC. Every trade is cleared through the DTCC. The vast, vast majority of them are sent in real time to the DTCC. New technology would have to be developed, I think, but there is a centralized point where they know at least all the equity positions for a clearing firm. So to the extent that it can be automated, it can be objective, I think we're in support of that discussion. Kill switch coordinated amongst the exchanges, I think that we have concern about in that it sounds great as a knee-jerk reaction. However, when I look at somebody's activity, and maybe they're trading 5 times what they were trading yesterday, it's not immediately clear to determine whether or not that is good or bad behavior.
What if it's
And
500 times? I mean, I agree with you, 5 times, but what if it's 500 times?
So maybe there is, you know, using your exaggeration, maybe there is some point at which we say, you kill it.
Right.
However, you know, we live in a day where, yeah, so who handles the liability of shutting that off? So if I kill a member, if I say, we're going to shut off all your access to the market, and we do that across all of our markets, and we don't know their full position, and they go out of business because we did that.
But I think that's a responsibility of an exchange. I mean, part of the problem today, if you take that to the extreme, is nobody really owns the quote. Nobody owns the quality of the market. And I
would
don't
say that's why, Andy, that's why I want it to be objective.
Right, I agree.
Based upon somebody's positions.
I agree.
And where they see a fulsome picture. You know, we see 12, 13% of the market, NASDAQ and NYSE see slightly more. It's hard to make a decision.
Right.
Based upon a limited view. And the DTCC sees all the trades. They could see them all in real time, I believe, with you know, maybe the demand of real-time trade reporting there. So we're open to that discussion. But, you know, in Knight's situation, I don't know how quickly their losses accrued. We know it happened over 45 minutes, but, you know, did all of that happen in the first 5 minutes? I don't know. And practically, it's going to, if there's any subjective judgment as part of that kill switch rule, or Joe and Eric and I have to get on the phone, it's going to take longer than that, and the damage is already done. So that's why it needs to be objective, and it needs to be electronic, probably with a human confirming, yes, I need to shut this firm off.
So is the better idea then to try and reinforce pre-trade standards?
I think actually what we've learned from Knight is that the market access rules are applied pre-trade. They certainly say they pre-trade, and there is a post-trade requirement that the sponsoring firm take in drop copies. However, if the firm is not a sponsoring firm, if they're trading on their own behalf, or if they're a clearing member themselves, it's a gray area whether or not they have to do post-trade risk management. So I think it's actually more of a post-trade question than it is a pre-trade question.
Andy, to your earlier point, I agree with you that it's an exchange's responsibility to manage make sure that the markets are operating fairly and appropriately. There is a gray line, though, between what is a broker-dealer's responsibility for their own behavior in the marketplace and what is damaging to the marketplace. And while NASDAQ is very supportive of introducing some form of kill switch as we go forward here in a way that makes sense for the marketplace, I also don't believe that, or I believe there's unintended consequences if you let every market actor off the hook and say, you don't have to do it yourself because we've got it for you.
Right.
You have to take some responsibility for your own behavior in the marketplace, and that has consequences to it.
We wouldn't want to eliminate the moral hazard issue entirely.
Right.
Your comments, both of you are spot on.
And I think that, absolutely, I guarantee you, there are projects going on throughout the industry as a result, because it was of the Knights issue, which is an incredible deterrent for the rest of the industry for this to happen to them again, regardless of any regulation.
Yeah, and I think that the point, just to echo and maybe bridge the comments Chris and Eric made, are, I don't think any exchange would be excited about going in the direction of systematically shutting off customers or having hard limits. But at the same time, if the general request from the market and the general view from the market is that there should be some sort of backstop, I think the important points that need to get incorporated in that are, number one, we shouldn't interfere with the normal operation of the market. Number two, it is just that, very much a backstop, so something that should trigger very infrequently in very extreme situations. And three, I forgot if it was Chris or Eric's point, but the primary responsibility should still lie with the firm that's generating the orders, right? This should not be a replacement or even viewed as a secondary check for them. This should be, extreme situations, once in a blue moon type events. But again, to Andy's point, are meant to protect the integrity of the market in situations where, for whatever reason, people's controls aren't working.
Great. Well, on that note, I'd like to open up to audience questions, members of the panel. So if anyone has a question, please ask.
My name is Julie Shaning. I'm a PhD student at Georgetown University. I would like to ask a question on a comment that Eric made earlier, that the bottom 1,000 listed NASDAQ stocks count for less than 1% of the volume. I was wondering if you believe there's anything the exchanges can actually do to improve the situation, because, for example, is there some market structure improvements or adjustments that can be adopted to encourage the activities on these small cap stocks? Or to the other extreme, there's simply not enough trading interest from the investors on these tiny stocks that they should just be kept in the private market, or somewhere in between, that there should be more research and marketing efforts from the analyst community to provide coverage to generate more interest. Any of the panelists? Thank you.
I think there's a couple of things. I mean, I don't think exchanges or even market structure can solve the problem in and of itself, right? So you identified some of the other issues that are out there, which is lack of research coverage. There's probably a dearth of investment banking support for those smaller companies. The investment banking ecosystem has changed considerably in the last 10 years. There were lots of smaller firms who made their living taking and supporting those companies, both as market makers, providing research, providing banking services. Many of those small companies are now gone. So there's a lot of complexity around it. But I think there are some things that we can try, and I want to make sure that people understand this as an attempted innovation. Obviously, we won't know if they work until we actually try them, but tick size is clearly one of them, right? Should there be a rational tick size for smaller cap companies that should be wider, allowing market makers to have an incentive to provide liquidity for those names? We in our markets in Europe engage in what we call market quality payments, where the issuer actually contracts with market makers to supplement what they make as a market maker and pay them to make better markets. We've proposed a model like that here in the US, and I know that NYSE has as well in some of the less liquid ETFs. We view that as an experiment. Where an issuer could, through an exchange-administered program, make market quality payments to market makers if they achieve certain metrics, tighter spreads, more liquidity, more size, time on the inside, all of those kinds of things. And then ultimately, I think there has to be a real question as to whether price time works for these smaller cap stocks. And maybe we should be looking back to, I'll refer to it as old NASDAQ. Where you have an order, it's more of an order routing system and order handling system between pools of liquidity as opposed to a central limit order book. I don't know that that's the right answer, but I do know that those are some of the things that we should be looking at to see if we should be changing the liquidity metrics for those smaller cap stocks.
I just want to follow up on this. So we got approved by the SEC for a competitive liquidity provider program in January of this year, and maybe unbeknownst to some people, we have 16 listed ETFs on BATS, and they're all illiquid.
We know, Chris.
Our competitors know, but the general public may not as much as we'd like. But we have 16 listed ETFs, and we realized that we're probably not going to attract spiders or Qs anytime soon. We're going to probably attract new issues, new products, but we need to incent market makers. And to Eric's point about market maker incentives, one way to incent market makers is to widen the tick size, so that when they capture the spread, they're making more money. Another way is that a lot of the way that market makers are compensated today in maker-taker pricing is that they get compensated when they trade, but obviously liquid securities don't trade very much. So what we came up with was a competitive liquidity provider program where there can be as many market makers registered as a competitive liquidity provider as they want, but they compete every second. Whoever has the most size at the inside for the most seconds in the day, they win a quoting reward. And the top competitive liquidity provider, he wins $200 a day per issue. And the second guy wins $50 a day. That doesn't sound like much, but if you get enough issues, over a year it adds up. And what we've seen is incredibly positive results with much tighter bid-offer spreads and significantly more size. You can't do complete apples to apples, but BlackRock, the issuer, kind of ran a test, and they listed some ETFs on NASDAQ and NYSE at the same time, and the results look rather positive. So I think there can be innovation here, and I believe we've tried to innovate, but then again, the market structure is not going to solve the investor interest problem, but to the extent where we can provide a good, tight market with depth, I think we're trying.
There was a good report by Grant Thornton a couple of years ago, which I would commend to your reading, as they say. And I think one of its primary conclusions was we need to reinsert the VIG in sort of telling the story of small companies, to encourage people to sponsor small companies and sponsor in a positive way, to promote small company investing in a positive way. And T. Rowe Price is a significant investor in small company stocks. And a lot of these companies have great stories, but nobody to tell them. So we've got to figure out a way to encourage all those firms that went out of business that Eric referred to bring those brokers back to tell their customers about the wonders of these companies. Challenging issue, though.
Hi, my name is Rick Joyce. I'm an alumni of the school and currently a private investor in New York. I think a comment I'd like to make that Maureen touched on was that innovation always leads market structure, or evolution always leads market structure. I think we've got, since at least 2005, when NMS and decimalization came upon us, that technology is leading innovation, and thus market structure, and it's changing faster than any of us imagined. we've had a great panel here, and it's really all we've talked about is micromanaging the trading process, which is one of the biggest difficulties that you're going to run into for an SEC to have to fulfill its three obligations. Number one, to protect the investor. Number two, to protect the marketplace. But number three, to ensure that capital is formed both investing-wise and corporate-wise. And if you just look at the empirical evidence, there's no more new issue business. Volumes are down because there's no more institutional flows. They're buying and holding. If liquidity is a big piece of the investment process, big institutions are not investing. They're buying and holding because the liquidity is not there. So, and if you then look at one thing that Andy brought up is the profit motive involved here. You know, fragmentation as a result of NMS versus what you lost was price discovery. Both the NYSE and NASDAQ went public because they raised capital to compete because they're losing share. I don't want to harp on the Facebook IPO, but at a time when investor confidence was ripe for a big shot in the arm with one of the most, you know, high-profile IPOs, the global marketplace would have gotten a great shot in the arm. And I think NASDAQ opening their stock knowing that their technology was somewhat subject, maybe they thought of the shareholder rather than the integrity of the marketplace. The fine in the newspaper today. What's the question? My question is that why don't we hear more about a central limit order book where regulation-wise, it's easy, it's efficient, and price discovery is inherent?
Look, what I guess I would say is you know, generally, it kind of echoes the earlier conversation we were having in that there's a lot of balance that needs to be found between a competitive market and, you know, some of the benefits that consolidated orders bring and price discovery, et cetera. I just don't think there's an easy way to address any of those issues in isolation. And, you know, I think it's why if we're going to address any of them, we need to have a more holistic debate around market structure.
Well, on that note, I'd like to say thank you for listening to the panel, and thank you to our panel for giving us some really interesting thoughts and things to consider. Thank you.